Hi, it's Jim Lane, the economic realist, coming to you from my messy classroom. Today, we published the last monthly newsletter on Substack yesterday. The Substack is substack.com/at the economic realist, and hope you'll subscribe. I'm going to be pretty brief today. I've got a bunch of Post-it notes to go through pretty quickly with you. I think for November, the 10-year U.S. Treasury tells the whole story. It ended November at or very close to the lowest yield of 2025, which was very consistent with the economic news flow. The macroeconomic news flow was just generally soft, generally dovish. And so despite what I would call irrational inflation rhetoric and Fed speak that remains mostly hawkish, I think we're going to get a rate cut in early December, and that is probably going to drive rate-sensitive investments higher. What I'm most excited about to talk to you today is about the stock I profiled that I think is worth a look. CF Industries, ticker CF, stock's around 80. I've been talking about fragile and anti-fragile because I read Nassim Taleb's book, Anti-Fragile, recently, and it's excellent read. I think CF Industries, CF shares, is really a non-fragile stock to highlight. It's a $12 billion market cap with less than $2 billion in net debt, and the company generates more than $1 billion a year in free cash flow. Recently, much more than $1 billion in cash flow, between $1 billion and $1.5 billion in free cash flow, which well supports the dividend, which costs them about $350 million a year. I title this stock a dividend god priced like a misfit, because you've got a current, using the trailing 12 months free cash flow yield, well above 10%, around 12% actually. You've got a dividend yield of 2.5%, but that's well covered, and I think the dividend could be going higher. This is a business that primarily manufactures and seems to distribute ammonia, which is critical to world food security. Absolutely critical to world food security, because this is used to maintain healthy nutrient levels in crop farming areas. So farms that grow cash crops, pretty much. Again, it's a dividend god priced like a misfit, and is critical to world food security. Some people have asked me in my conversations, so why is it so cheap? Well, chemical fertilizer companies historically have had very, very wild swings in margins. It's a high fixed cost business, and so they've got to maintain consistent gross margins in order to generate consistent free cash flow. This company, I think, is best of breed in what has been a tough industry to make long-term gains in owning stocks historically. I think they're coming up with their secret sauce to maintain margins. I think it's worth more than $135 today. It's priced at about $80, and you got a nice dividend with the potential to go up, getting paid to wait around, which is what I like. What else did I have here? Over $1 billion in free cash flow annually, supports the $350 million in annual dividends, which again I think are going higher. The risk is always margins. Some sensitivity to natural gas prices. They seem to be much more vigilant in this area the last few years than most of the companies in the industry have been historically. And so you mentioned chemical fertilizer companies. Many people in the investment community, and they roll their eyes because there's always a promise of consistent margins, and then there's always big flops. So all of this and my macroeconomic commentary can be read on my Substack, which is substack.com/@the-economic-realist. Sorry for all the ums and the delays and the notes, but we're all busy, and I only do these in one take, so hopefully they'll get better. And good luck on December and the new year.